Right now, something is happening in the gold market that most people aren't paying attention to. And I'm not talking about the price going up or down. I'm talking about a structural shift that's been building for months, and we're approaching a critical inflection point. Let me show you what I mean. In the last 6 months, central banks have purchased over 800 metric tons of gold. That's not normal. That's not even close to normal. To put that in perspective, during the entire decade of the 1990s, central banks were net sellers of gold. They were dumping it. They thought it was a barbarous relic, something from the past that had no place in modern finance. But something changed, and it wasn't gradual. It was sudden, deliberate, and coordinated. The People's Bank of China has been adding to their gold reserves for 17 consecutive months. Not 1 month, not 3 months, 17 months in a row. And here's what's interesting. They're not just buying a little bit here and there. They're buying in size. We're talking about 20 to 30 tons per month, every single month, like clockwork. Now you might be thinking, okay, China's buying gold, so what? They've always liked gold. But here's the thing. China isn't alone. Poland just announced they're increasing their gold reserves by 100 tons. Singapore's been quietly accumulating. India's central bank has been one of the largest buyers. Even countries you wouldn't expect, like Turkey and Kazakhstan, are loading up on physical gold like there's no tomorrow. Why? What do they know that the average investor doesn't? Let me take you back to 1971 for a moment. August 15th, 1971. President Nixon goes on television and announces that the United States is closing the gold window. No longer would foreign governments be able to exchange their dollars for gold at $35 an ounce. It was supposed to be temporary. Nixon said it himself, temporarily suspending the convertibility of the dollar into gold. 54 years later, that temporary suspension is still in place. And in those 54 years, something remarkable happened. The dollar became the world's reserve currency, not because it was backed by gold, but because it was backed by trust. Trust in American institutions, trust in American military power, trust in American economic dominance. But trust is a fragile thing. And right now, that trust is eroding faster than most people realize. Here's what's happening behind the scenes. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been working on an alternative to the dollar-dominated financial system. They're not just talking about it anymore, they're building it. They've invited over 40 countries to join their alliance, and at the center of this new system, gold. Not a gold-backed currency necessarily, but gold as a settlement mechanism for international trade. Think about what that means. If you're a country that wants to buy oil from Saudi Arabia, instead of using dollars, you could settle the transaction in gold. Or in a currency that's partially backed by gold. Or in a digital currency that's linked to gold reserves. This isn't conspiracy theory. This is happening right now. Saudi Arabia, the cornerstone of the petrodollar system, just joined the BRICS alliance. Let that sink in. The country that has been the linchpin of dollar dominance for the last 50 years is now exploring alternatives to the dollar. And here's where it gets really interesting for gold owners. Because if you understand what's coming, you understand why time is running out to position yourself correctly. Let me explain the mechanics of what's about to happen. Right now, the gold market is dominated by paper gold. Futures contracts, ETFs, unallocated gold accounts. For every ounce of physical gold that actually exists, there are estimates of 100 to 200 ounces of paper claims on that gold. It's a fractional reserve system, just like banking. And just like banking, it works fine until everyone wants their gold at the same time. Here's the problem. Central banks don't want paper gold. They want physical gold. They want bars sitting in their vaults. And when you're buying 20, 30, 50 tons per month, you're not buying futures contracts. You're buying actual metal. You're taking delivery. You're draining physical supply from the market. Now, the COMEX, the major exchange where gold futures are traded, has about 20 million ounces of registered gold. That's gold that's available for delivery. Sounds like a lot, right? But here's the thing. At current rates of central bank buying, that's less than 4 months of supply. 4 months. And it's not just central banks. Wealthy individuals are starting to catch on. Family offices are allocating more to physical gold. Sovereign wealth funds are buying. Even some hedge funds, the same people who used to mock gold as a pet rock, are now accumulating physical metal. What happens when the available supply runs out? What happens when there are more claims on gold than there is actual gold to deliver? Let me tell you a story about what happened in the nickel market in March 2022. The London Metal Exchange had to halt trading and cancel billions of dollars worth of trades because there was a short squeeze. The price of nickel went from $30,000 per ton to over $100,000 per ton in a matter of hours. The exchange literally had to step in and say, "Those trades don't count. We're reversing them." Now imagine that happening in the gold market. Except gold isn't just another industrial metal. Gold is money. Gold is the foundation of central bank reserves. Gold is what countries use to settle international debts when trust breaks down. You can't just cancel gold trades and pretend it didn't happen. The implications would be catastrophic for the entire financial system. And here's what most people don't understand. The people who are going to get hurt the worst are the ones who think they own gold but actually don't. If you own shares in a gold ETF, you don't own gold. You own shares in a fund that owns gold. And in a crisis, when everyone's trying to redeem their shares at the same time, you're going to find out very quickly that there's not enough physical gold to go around. If you own unallocated gold in a bank account, you don't own gold. You own a promise that the bank will give you gold. And we all know how good banks are at keeping their promises when things get tough. The only gold you really own is the gold you can hold in your hand, or the gold that's sitting in a vault with your name on it, in a segregated account, where you can verify that it's actually there. Now, I want to pause here for a second because this is important. If you're sitting on $100,000 or more in retirement accounts, there's something you should know about. It's called a gold IRA, and it's a way to get physical gold into your retirement account without triggering taxes or penalties. I put together a free guide that explains exactly how it works. It's in the description below. No pressure, but if you're thinking about protecting your retirement savings with physical gold, it's worth checking out. All right, let's get back to what's happening in the market right now. There's a concept in markets called backwardation. It's when the spot price of a commodity is higher than the future price. In normal markets, the future price should be higher because of storage costs, insurance, and the time value of money. But when a market goes into backwardation, it means there's a shortage of physical supply right now, today. Gold has been flirting with backwardation for months. And when I say flirting, I mean we're seeing brief periods where the spot price is actually higher than the near-term futures price. That's not supposed to happen in a well-supplied market. You know what else is happening? Premiums on physical gold coins and bars have been elevated for over a year. When you go to buy a gold eagle or a gold buffalo from a dealer, you're paying $80, $100, sometimes $150 over the spot price. Why? Because there's more demand for physical gold than there is supply. The mints can't keep up. The US Mint, the Royal Canadian Mint, the Perth Mint, they're all running at full capacity and they still can't meet demand. There are waiting lists. There are delays. There are allocation limits. And this is happening while the price of gold is relatively stable. Imagine what happens when the price starts moving. Imagine what happens when the general public wakes up to what's going on and decides they want to own physical gold too. Let me paint you a picture of what that looks like. It's 1980. Gold has been in a bull market for a decade. It's gone from $35 an ounce to over $600 an ounce. And then, in the final few months of the bull market, it goes parabolic. It doubles in less than 3 months, hitting $850 in January 1980. But here's what most people don't remember about that time. You couldn't buy gold. The dealers were sold out. The premiums were 30%, 40%, sometimes 50% over spot. People were waiting weeks or months to get their gold, and if you wanted to sell, you could sell instantly because there were so many buyers and so few sellers. That's what a real gold mania looks like. And we're not even close to that yet. Right now, gold ownership among the general public is at historic lows. Most people don't own any gold. Most people don't even think about gold. It's not on their radar. But it's on the radar of the people who matter, the central bankers, the sovereign wealth funds, the billionaires, the people who understand how the financial system really works. And they're not buying gold because they think it's going to go up 10% or 20%. They're buying gold because they think the current system is unsustainable. They're buying gold because they see what's coming, and they want to be positioned on the right side of history. Let me show you what I mean by unsustainable. The United States has $36 trillion in national debt. That number is so large it's almost meaningless. But let me put it in perspective. The U.S. government is now spending more on interest payments on the debt than it spends on defense, more than it spends on Medicare. The interest on the debt is becoming the largest line item in the federal budget. And here's the kicker. Those interest payments are being made with borrowed money. The government is borrowing money to pay the interest on the money it already borrowed. That's not a sustainable situation. That's a debt spiral. Now, there are only 3 ways out of a debt spiral. You can grow your way out, but that requires economic growth that's faster than the growth of your debt. Not happening. You can cut spending and raise taxes, but that's political suicide, and it causes a recession. Or you can inflate your way out. You can print money and devalue your currency until the debt becomes manageable in nominal terms. Guess which option governments always choose? They always choose inflation. Always. Because it's the path of least resistance. It's the hidden tax that most people don't understand. And when governments inflate, when they devalue their currencies, what happens to gold? Gold goes up. Not because gold is becoming more valuable. Gold is just sitting there, being gold, same as it's been for 5,000 years. Gold goes up because the currency is becoming less valuable. That's what's happening right now. That's why central banks are buying. They know what's coming. They know that the dollar, the euro, the yen, all the major fiat currencies are going to lose purchasing power. And they want to protect their reserves with something that can't be printed, can't be devalued, can't be inflated away. But here's the thing that keeps me up at night. There's not enough gold to go around. If every central bank in the world wanted to back even 20% of their reserves with gold at current prices, there isn't enough gold in the world to do it. The math doesn't work. So what happens? Either the price of gold has to go up dramatically to balance the equation, or some central banks are going to be left holding the bag with nothing but paper promises. And this is where the limited time comes in. Because right now, you can still buy physical gold at reasonable premiums. You can still get delivery in a reasonable time frame. You can still position yourself before the crowd figures out what's happening. But that window is closing. Every month, central banks are taking hundreds of tons of physical gold off the market. Every month, the available supply shrinks. Every month, the ratio of paper gold to physical gold gets more extreme. There's going to come a point, and I don't know exactly when it will be, but there's going to come a point where the market breaks, where the paper price and the physical price diverge, where you can see gold quoted at $2,500 an ounce on your screen, but you can't actually buy physical gold for anywhere near that price. We've seen this happen in other markets. We saw it in silver in 2008 during the financial crisis. The paper price of silver crashed, but you couldn't buy physical silver anywhere. The dealers were sold out. The premiums were astronomical. The paper market and the physical market completely disconnected. And when that happens in gold, when the paper market and the physical market disconnect, that's when you're going to see the real move. That's when gold doesn't go up 20% or 30%. That's when gold goes up 100%, 200%, maybe more. Because at that point, it's not about investment returns anymore. It's about survival. It's about having something real, something tangible, something that holds value when everything else is falling apart. Let me tell you about what happened in Weimar Germany in the 1920s. The German mark was one of the most respected currencies in the world. Germany was an industrial powerhouse, and then, in the space of a few years, the mark became worthless. People were using wheelbarrows full of cash to buy a loaf of bread. Life savings were wiped out overnight. But you know who survived? The people who owned gold. The people who owned real assets. The people who understood that paper money is only worth something as long as people believe it's worth something. And when that belief breaks, when confidence is lost, it happens fast. It doesn't happen gradually. It happens in a rush. One day everything seems fine, and the next day there are lines at the banks and the ATMs are empty and the currency is in free fall. I'm not saying that's going to happen tomorrow. I'm not saying that's going to happen next month. But I am saying that the conditions are being set for exactly that kind of crisis. The debt levels are unsustainable. The money printing is out of control. The trust in institutions is eroding. The geopolitical tensions are rising. And the smart money, the people who have access to the best information and the best advisors, they're preparing. They're buying gold. They're taking delivery. They're getting their wealth out of the system and into something that can't be confiscated, can't be devalued, can't be printed. Here's another thing that's happening that most people aren't aware of. The COMEX is changing its rules. They're making it harder to take delivery of physical gold. They're increasing the margin requirements. They're adding restrictions on who can stand for delivery and how much they can take. Why would they do that? Why would they make it harder for people to take delivery of the gold they supposedly own? Because they know there's not enough physical gold to meet the demand. They know that if everyone who owns a gold futures contract decided to take delivery, the system would collapse. So they're changing the rules to prevent that from happening. They're rigging the game to protect the banks and the institutions that are short gold, that have sold gold they don't have, that are betting on the price going down. But here's the problem with rigging the game. Eventually, people figure it out. Eventually, people lose confidence in the system. And when that happens, they don't just stop playing the game. They take their ball and go home. They take their money out of the paper markets and they buy physical gold from dealers, from mints, from private sellers. And that's when the real shortage begins. That's when the premiums explode. That's when you can't get gold at any price. I've been watching this market for over 20 years. I've seen bull markets and bear markets. I've seen manias and crashes. And I can tell you, what's happening right now is different. This isn't just another cycle. This is a structural shift in the global financial system. The dollar's dominance is ending. Not tomorrow, not next week, but it's ending. And when the dollar loses its status as the world's reserve currency, when countries stop using dollars for international trade, when central banks stop holding dollars as their primary reserve asset, the implications are going to be profound. Gold is going to be at the center of the new system. Not because anyone decided it should be, but because gold is the only asset that every country trusts. It's the only asset that has no counterparty risk. It's the only asset that has maintained its value for thousands of years. And the countries that have the most gold are going to have the most power in the new system. That's why China's buying. That's why Russia's buying. That's why India's buying. They're positioning themselves for a world where gold matters again. But here's what you need to understand. When this transition happens, it's not going to be smooth. It's not going to be orderly. There are going to be winners and losers, and the losers are going to be the people who are caught holding paper assets when the music stops. The winners are going to be the people who saw it coming and positioned themselves accordingly. The people who own physical gold. The people who own real assets. The people who understand that in times of crisis, tangible beats intangible every single time. So when I say gold owners have limited time to prepare, this is what I mean. You need to make sure you actually own gold, real gold, physical gold, not paper promises, not ETF shares, not unallocated accounts. You need to know where your gold is. You need to know that it's in a secure vault with your name on it. You need to know that you can access it if you need to. You need to know that it's not being lent out or hypothecated or used as collateral for someone else's trades. And you need to do this before everyone else figures it out. Because once the crowd wakes up, once the mainstream media starts talking about gold shortages and delivery delays and paper market failures, it's going to be too late. The premiums are going to be through the roof. The wait times are going to be measured in months, not days. And you're going to be competing with millions of other people who all want the same thing at the same time. This is not about trying to time the market. This is not about trying to buy at the absolute bottom and sell at the absolute top. This is about recognizing a once-in-a-generation shift in the global financial system and positioning yourself on the right side of that shift. The central banks have already made their decision. They're buying gold as fast as they can. The sovereign wealth funds have made their decision. The billionaires have made their decision. The question is, have you made yours? Because the clock is ticking. The physical supply is shrinking. The paper market is becoming more unstable. The geopolitical tensions are rising. The debt levels are exploding. The money printing is accelerating. All the pieces are in place for a major disruption in the gold market. And when that disruption comes, the people who are prepared are going to be glad they acted when they did. And the people who waited, who thought they had more time, who didn't think it could happen to them, they're going to wish they had listened. The time to prepare is now. Not next month, not next year, now, while you still can, while physical gold is still available, while the premiums are still reasonable, while the system is still functioning. Because once it breaks, Once the paper market fails, once the shortage becomes obvious to everyone, it's going to be too late. The gold will be gone, the window will be closed, and you'll be left holding paper in a world that suddenly remembers why gold has been money for 5,000 years. Don't let that be you. Don't be the person who saw the warning signs and did nothing. Don't be the person who thought it couldn't happen. Because it can happen. It is happening. And the people who understand what's coming are taking action right now. The question is, will you be one of them?